Hi everybody. So here we go with another quarterly market update on the crypto and blockchain sector. Interesting times at the moment with Bitcoin moving through 10K 3 times this year and corresponding market interest in altcoins, something we didn't see much of during 2019 when Bitcoin was rallying at that time. Today's presenters are Techeme capital trader Josh Olszewicz, who will talk about trading the trends with a focus on altcoin and Bitcoin correlations and the current state of Ethereum. BNC's research director Andrew Gillett will join us to talk about macro trends, including the impact of coronavirus and any rush to Bitcoin or gold as a store of value as a result of that. And BNC Markets analyst Aditya Das will take a look at the wider implications of China's health emergency and the all-important Bitcoin halving that's expected to occur in May. And just a reminder, crypto assets are very high risk, so do conduct your own due diligence before making any investment decisions. And now, let's hear from Josh with a market overview.
My name is Josh Olszewicz. I'm a trader at Techeme Capital. I'm also an analyst and writer for Brave New Coin. And let's go over a retrospective of Q4 2019. So one thing that I've noted for the past few years, I've been in crypto since 2013, and something that we've noticed as traders is that the trends themselves in crypto are highly correlated to the quarterly rollover periods, as in we'll put in a high or a low for the entire trend at a quarterly rollover. So this could have something to do with futures market as well as just the general business cycles or human calendar cycles. But I think the most obvious few examples are January 2018, clearly the all-time high top. July 2019, clearly a local top here. January 2019, local low. January 2020, local low. So you can see that from July to January, it was nothing but straight bearish momentum. And as soon as the year flipped, it's bullish again. One thing looking at the golden crosses, so this is the 50 EMA and the 200 EMA, just moving averages, which calculate 50 versus 200 day periods prior to the price. And just as we had a golden cross, this is what this is referred to as when the 50 crosses over the 200, we have a golden cross currently, and we're seeing a lot of bullish momentum off of that. And this is the total market cap of crypto, including alts, including scam projects, everything. So overall, very bullish. We broke the 200 similar to April pretty cleanly, retested it. Throughout Q4, we were held down below the 200, bearish momentum. So even if you think technicals are less than ideal for analyzing a market, at the very least, some bare bones stuff I think is important to know. Now looking at the entire market, so this is the top 10 alts, just their market caps. You can see that in general, everything Q4 wise sort of was sideways or down, except Tezos. Tezos kind of blasted off here and it's ahead of the scrum. Now a lot of individual communities think their coin is doing particularly well, when in actuality, the entire market is doing well. And when the entire market does well, these coins are very highly correlated. When it does poorly, these coins are highly correlated. Another bad reason to trade basket indices or indices in general. As separate entities, this stuff all moves together. BTC moves up with all the rest of them. It moves down with all the rest of them. So it's really hard to pick individually which will outperform. The only two alts that outperformed BTC last year were Tezos XTZ and Chainlink. BNB I think also outperformed slightly, if my memory is correct. But in general, everything else did not outperform Bitcoin. Looking at the altcoin market cap, which is essentially these top 9 or 8 currencies here, excluding Tether. Again, you can see a clear downtrend from Q2 to the end of Q4 last year, and immediately an upthrust bullish momentum at the beginning of the year. Again, you can note the bullish 50-200 cross. You can note the crossing of the 200 EMA to the upside. Previously, if you want to go way back retrospectively, Price was below that entirely. Another thing you can pay attention to as far as moving averages, when price is extremely away from the 200, it likes to come back. That's referred to as mean reversion. So anytime it gets heavily, above the 200 or below the 200, it always likes to come back, sort of retest the trend and determine momentum from there. So you can see even throughout Q2 and Q4, or Q3 and Q4 last year, we had this retest of the 200 twice and a failure to breach, and it just went down further. Now we had a break above the 200, a retest of the 200, and off she goes. I still like to see as a trader a retest constantly of these support and resistance levels to determine if the trend has continued momentum. What I don't want to see is a breach of the 200 and then immediate failure of the 200. What you want to see is either no doubt about it, 50, you can see it was held below the 50 here and mostly held below the 50. You either want to see that definite strong momentum or several retests like we did here to confirm the trend. That way, the trend is your friend. There's no confusion as far as where you should be looking for trades, long or short. Looking at Bitcoin dominance, which is a percentage of the total market cap, including altcoins. So this is a line graph here. And again, we have the 50 in the green, the 200 in the red. I made that a red fill. And essentially what I'm trying to say here is anytime the Bitcoin dominance has dropped below the 200-day moving average, alts have done extremely well. Any coin that isn't Bitcoin has outperformed BTC. You can see mid-2018 to 2019, BTC's outperforming, and again in 2019, BTC's outperforming. Currently, BTC is underperforming many altcoins, and you can see that the flip from altcoin dominance being strong to Bitcoin dominance being strong basically occurred when ICOs peaked. So when new coins were being added to the market, Bitcoin dominance was decreasing, and then when that stopped, Bitcoin dominance was increasing again. Looking at Bitcoin quarterly price changes, Q4 historically has been really good for Bitcoin, which was made the 15%-ish down move from beginning to end of the quarter a little bit rare, considering historically how well Q4 has done. Another thing to note is Q2 across the board is the best quarter for crypto. Now it'll be interesting to see how well Q2 does this year for two reasons. One being that Q1 has outperformed historically, in my opinion, excluding the 600% in 2013. For the most part, Q1 has been less than 10% and mostly negative, partially likely due to tax reasons. So the second thing would be halving is coming up, the block reward halving. So if demand stays the same or increases as supply goes to nothing, not goes to nothing, but it literally halves, that should have a positive bullish effect on the market. Looking at active addresses on the network, this is on-chain stuff that I would consider fundamentals of the network, and network difficulty, which is hash rate related, so mining. The black line are the active addresses, and the difficulty is the red line here. So what I like to see if I'm bullish, I like to see more hash rate being added to the network. I like to see network difficulty increasing. So this means miners have a harder time getting Bitcoin. The network algorithm continues to get harder and harder to mine Bitcoin as hash rate is added. It is not easy to build the infrastructure and buy the ASICs and implement all this stuff. This is a multi-million-dollar project of scale, typically, or it represents many individual miners, hobbyists, that sort of thing. Much less likely to affect hash rate and difficulty over time just because it's a much smaller percentage of the total hash rate. So this is bullish, hash rate going up, difficulty going up. The other thing I'm seeing, active addresses, which are just addresses that have changed value or have been created and changed value over a specified period. And you can see essentially from 2018 to 2019, it was down and flat. From January to July 2019, active addresses increased dramatically, and we saw the increase in price. From July to January 2019, decrease in active addresses, decrease in price, And again, immediately in January, we're seeing a pickup in active addresses. Another reason to be very bullish on price. Going back to technicals, if we look at a historic trend to channel, specifically known as a pitchfork, we can see that historically, based on these anchor points, price has enjoyed being in this green and white zone. This goes back since 2015. This is the BLX. Sorry, this is actually Bitstamp. It looks a little different on the BLX, but so I use Bitstamp for this specifically. But overall, it doesn't like being above. It doesn't like being below. Price prefers to be in this median zone. You can see much of the local high throughout last year, mid last year, was spent in this median zone, and the low put in January sort of matched the lows in early 2019 as far as the trend to channel goes. So what I'm expecting over the next few months is a return to this green and white channel and an ultimately a touch of this yellow line, which is the median line. It's aggressive. This is a logarithmic chart. So irrespective of price, irrespective of time frame, this is where historically price has been. And that's essentially a $19,000 target by January 2021. Zooming in a little bit, again, 15K, and that's going to continue to increase as time goes on, just because that's the historic rate of change has been very aggressive. And I'm confident in this because it's been contained for the most part to this range or to the upside. So at bare minimum, I'd expect a return to this median line, median range up here. Another thing we like to look at is the CME futures contracts. So how futures work is they have an open and an expiration date. So that's what you're seeing here, all these dates on the chart here. And I just drew in the corresponding prices. So this is Bitfinex. This isn't actually CME chart, which has market opens and market closes and gaps and all sorts of things. That's why I prefer to use the Bitfinex chart. But looking at the biannual contracts, which are the long dated contracts, historically these have either been up or down. They've been binary. Essentially, the top is basically in or bottom is basically in at the beginning or the end of the contract. So currently we're plus 25 to 30% at this point of the December 30th to June 26th contract, which to me signals this should be an up contract. We shouldn't put in lower lows this quarter than the open. You can see the CME options contracts opened this quarter or during this biannual contract as well. And so far they've been extremely bullish since the open, which is a good sign. One last thing I'd like to note about the futures contracts is the expiration and open dates typically have increased volatility. Just eyeballing it in general, you can see there's been big spikes in price momentum one way or the other on these dates. CME's also opened up several long dated contracts, which basically go through halving. And you can see some of these are this year, and there's two that are very long dated that go out to December 2021 or January 2022, basically. And you can see that the December 16th contracts were basically the local low for the entire current trend. So again, just hitting home, like there's a lot of volatility on these dates. They're very important, even though this is a cash settled versus BTC market. Just the size alone, the fact that it's all real volume, it's institutional, everyone's watching this stuff. Looking at Backed and their futures volumes are up. Open interest is slowly creeping up. Overall, there's still a small slice of the total CME stuff. These are BTC settled, not cash settled. So a little different than CME, but overall, more products, the better from the institutional side. The more exposure for people, the better. Looking at ETH, now ETH's Q4 was right on the money at negative 30. Historically, it's been around negative 30 if it has a negative quarter. Q4 has historically been the worst quarter for ETH. Q1 and Q2 have been the best quarters, so the current price action isn't a surprise. It'll be interesting to see what happens for Q2, which again is historically the most bullish for everything across the board. Some future key events in July 2020. ETH is going to start switching over to proof of stake versus proof of work, and that just means people can take their coins and essentially earn interest on them. Tezos is one example of a network that has done this recently, that's been released recently, and is doing really well with it. Basically because anybody on an exchange is able to buy the Tezos and then immediately temporarily lock it up and start collecting interest on it. The other thing to mention is the potential of the current consensus algorithm being adjusted. So how I was mentioning ASICs for Bitcoin, some chains take a different approach and they want to get rid of ASICs on the chain to increase decentralization from mining. So ETH is in a bit of a flux from that perspective. Not only do they want to change the algorithm to kick off ASICs, but they also want to implement proof of stake, at least the beginnings of proof of stake, sometime this year, mid-July or later. So if we look at ETH's active addresses, the black line again, and the network difficulty, the red line, the first thing I'll point out is the network difficulty. Again, if you're a miner and you're thinking, not only are they going to change the algorithm on me, but they're going to try to remove me from the network, the incentive to scale this multi-million-dollar thing to build a mining farm just isn't there because of the uncertainty. So you're seeing that on the network difficulty. It's continued to decline over the past 2 years. Active addresses have also continued to decline over the past 2 years as a whole. I mean, they were up basically from early 2019 to mid-2019, just like BTC. They aren't necessarily up now this quarter, which makes the ETH up move even less more sense to me because there isn't a fundamental reason that I can point to on the chain metrics. Although the DeFi narrative, decentralized finance narrative, has definitely picked up steam over the past few months. So looking at ETH, this is the ELX. Looking at ETH's 50 and the 200, the green and the red line here, you can see it's got its golden cross at this point, and it broke the 200 cleanly. It retested it, and off to the races it was, as opposed to last quarter where it was bouncing down from the 50, bouncing down from the 200. So much different price action this quarter than last quarter. Looking at ETH's potential pitchfork here, this is the Bitfinex chart, but looking at these anchor points, we can paint a target of somewhere between 250, 350 in the immediate future, and that's already hit over the past few days. ETH's currently at 255. It had a local high of around 290 on the ELX. Another thing to pay attention to, this is the volume profile of the visible range here, these horizontal bars, which essentially just show volume at the specific price. And you can read these as support and resistance areas as well. So 300 is a massive zone. As we saw over the past couple weeks, it's going to be a bear to break the 300 level because there's so much interest there. It's a psychological resistance point. There's also a yearly pivot resistance point here, which are determined by the highs and lows of the previous year. So there's a lot of reasons to chill around 300, consolidate, and then make a decision from there. But as a whole, historically, again, not much price action to determine this trend as opposed to BTC, which has 5 years at this point. This is a fresh pitchfork, but it is pointing to targets in the 450 range late this year. Looking at token sales and raises per month, this is ICOs, sales that have ended, and the total raises in USD. And again, you can see historically it sort of peaked mid-2018 and has just fallen off essentially to nothing in these early months of Q1 and Q4 2019. There was just really nothing there. So the Ethereum demand for ICOs has dropped off. The treasuries of the ICOs that have collected in the previous years has also continued to decline. To me, this is a good thing. This represents a supply glut, a potential sell-off bearish overhang, because as price continues to fall, or if price falls, these treasuries will likely sell, panic sell, as they did in Q4 2018 when we had the highest decrease in ICO treasuries. They'll also likely sell as price is increasing because they're saying it's time to take profit on this ETH position. Essentially, that's our treasury, that's our runway. Another way you can look at this is many of these ICOs are going into their second, third, fourth, fifth year of operations, and they need cash to pay bills, to pay overhead. So they're going to sell their ETH. So the quicker this goes to zero, the better. The quicker this ETH gets distributed among everyone else, the better. Now, as opposed to what I just discussed with ICO and ICO treasuries, the DeFi narrative has kicked off very hard recently as it's breaking the $1 billion barrier. And essentially what DeFi is or does is allow you to take loans on ETH collateral or provide loans for ETH collateral and various other trading mechanisms. And you can see that although the ETH value, or although USD value has increased, ETH value, total ETH locked, hasn't continued to increase. It's essentially plateaued around 3 million. Again, another reason that this ETH move makes a little less sense to me. I would expect that if ETH price is skyrocketing, ETH being locked up would also be skyrocketing. Looking at Dex Volume, these are decentralized exchanges as opposed to centralized exchanges. And historically, we just haven't seen much volume or traders on these exchanges. One thing you may see down the line if ETH price increases and altcoins prices increase as well is a kick up of both volume and traders on these decentralized exchanges. Looking at Ripple, historically Ripple's quarterly percentages have kind of been all over the map. Their highs have been extremely high and their lows have been a little more frequent as far as the negative quarters are concerned. And Ripple may have an IPO this year, Ripple the company. So that's one thing to watch for. Not related to Ripple, the token.
Hi, my name is Aditya Das and I cover markets at Brave New Coin. I will be presenting the next section of the presentation titled A Perfect Storm to Begin 2020. So this section covers some of the major macro headwinds that have helped push up the price of Bitcoin through the first quarter of 2020. The price has risen over 30% year to date and looks to be on course to continue a positive bullish macro trend. This run-up has coincided with a few large macro stories, narratives that have intuitively driven the price uptick. The first is the coronavirus, which has had a serious impact on perceptions of the stability of the Chinese global supply chain, and also has directly affected the current prospects of the Chinese global supply chain by causing an extension to the Chinese New Year holiday and affected a number of startups that depend on China for manufacturing. So yeah, if we look at this chart, we see that Bitcoin had a relatively quiet Q4 2019, as Josh mentioned. But beginning pretty much immediately from January the 1st, we saw a large increase in buying activity, which continued and sort of intensified beginning around mid-January. This coincided with the first reported death from the coronavirus in China, and also the beginning of screening in 3 major US airports for the coronavirus: San Francisco, New York, and LA, and was kind of the triggering point for when the coronavirus became a mainstream news story. And as that has sort of the larger the story has gone, the better the price of Bitcoin has done. The primary reason for this is a perception of Bitcoin growing as a hard asset or a hedge against global political uncertainty or global supply chain uncertainty. We have seen the price of other hard assets like gold and precious metals also do well against the outbreak of the coronavirus, while we have seen a slide in investments which are dependent on the China global supply chain for their fundamentals. So things like manufacturing or industrials or supply chain investments have done poorly in the short term as investors perceive the coronavirus quarantine and the extension of the Chinese New Year holiday to be a bearish signal. Just shifting base to the impact Bitcoin's new sort of hard asset narrative, short-term hard asset narrative, or short-term political hedge narrative has had is to the wider crypto market. We've seen altcoins also sort of catch this macro headwind and in fact grow much quicker than Bitcoin has. This is somewhat expected. Generally, a pattern of Bitcoin investors diversifying relatively quickly into alts or earning profits and quite quickly using those profits to buy alts has happened before. And because altcoin markets tend to be less liquid and smaller, it takes less of a capital injection to move the price of these assets or increase their value percentage-wise. So that's what we've seen. So Bitcoin's kind of macro narrative gains have been altcoins gains as well. And yeah, that market has driven up quite quickly too. And again, just to give you a kind of a more granular picture of the performance of alts, we've seen that while Bitcoin has grown an impressive 26% in price since this in the last 30 days, assets like Tezos, Chainlink, Cardano, Bitcoin SV have had kind of astronomical gains that dwarf Bitcoin's. This is likely because these markets are smaller and it's easier for bulls in these markets to push the price up or drive the percentage value of these assets. Some of these assets have also had their own sort of macro fundamental headwinds. XTZ, for example, has benefited quite largely from a number of retail platforms offering proof of stake services for users. So platforms like Coinbase Pro and Binance now offer staking and passive income on XTZ holdings of users. So this means users don't have to move their assets on chain to earn a passive income on them. And they can just do it directly on the trading platforms they buy XTZ from. Now shifting back to some data and the coronavirus narrative, we see how closely correlated the BTC price and Corona Google search interest have been this year. Yeah, so what's been quite interesting is as well as the price of Bitcoin rising quite rapidly, coinciding with a rise in retail interest or internet interest in the coronavirus, we've also seen the price kind of plateau as search interest in the coronavirus has died down a little bit. So yeah, we normally tend to suggest that crypto markets are influenced more heavily by retail activity than by institutional activity. So yeah, that's what we might be seeing here, that it's mainly kind of retail on the ground internet users of platforms like Binance that are driving the price. And that's what the Google trend signal suggests, is the retail activity or the retail signal of crypto markets. And again, talking about some of the direct effects of the coronavirus, these are the price charts for a couple of Dow 30 stocks. So one is 3M and the other one is the Walgreens Boots Alliance. 3M is a pretty large property stock with a number of international operations, and its fundamentals and its horizons have been seriously affected by the outbreak of the coronavirus. There are suggestions that their supply chain or their immediate supply chain requirements may have to be shifted to other parts of Asia. And we see a similar story for other kind of supply chain operations heavy international stocks. So pharmaceutical stocks like WBA, the Walgreens Boots Alliance, stocks like Chevron, Merck, the big Canadian pharmaceutical stock, have all kind of done poorly in the background of the coronavirus, while hard assets, which shouldn't be affected by any kind of disruption of the Chinese global supply chain, like gold and Bitcoin, have done quite strongly. We've also seen kind of US-focused tech stocks like Tesla and Beyond Meat, which aren't really don't have big markets in Asia, perform well as well. So this narrative is kind of playing out as we'd expected, and then the data backs up the intuition. And yeah, just to follow up on this point, we've seen that Bitcoin's fundamentals, as defined by its hash rate, which is the amount of power used by the Bitcoin network and can be perceived to be a signal of demand to mine the Bitcoin network, has continued to rise steadily despite the outbreak of the coronavirus or a tendency for Bitcoin mining to be focused in China. Electricity continues to be sunk into the network and mining has not continued. It potentially could have gone indoors, but with other kind of startups or assets which are dependent on manufacturing or factories in China, Bitcoin's hash rate and its electricity consumption has continued to rise, backing up investors who are driven by this sort of macro hedge unaffected by the rest of global market narrative. So yeah, the other big macro event which could be being priced in right now and is driving the price of Bitcoin upwards is the Bitcoin halving, which is set to happen in May, based on the current average daily block times. The halving is an event that occurs approximately every 4 years. Josh touched on it earlier, where the block reward earned by miners halves. It essentially means less Bitcoins are produced by the network each day, And miners are essentially competing for fewer Bitcoins. So it is an increase in difficulty, probably a decrease in mining profitability because, fewer block rewards, more competition for the fewer block rewards. But it also means that BTCs produced after this date are more scarce. So essentially, you're closing the tap. So that means the value of the existing Bitcoins, as long as there's demand for them, will rise because the supply has shrunk. It's pretty simple supply and demand. And historically, you've seen quite strong price activity on halving years. There tends to be kind of a staggered effect where 3 or 4 months after the halving, we see large price pickups or some FOMO purchasing months out before the halving, before it gets priced in. The current halving, which is the third block reward halving, has been driven by a stock to flow narrative, which has given analysts a quite direct signal for how to assess or predict what the price could be of the halving. So it is a major macro narrative and could be something of a self-fulfilling prophecy as traders and speculators buy into the scarcity argument and start purchasing Bitcoin based on that thesis. So the halving or investors preemptively purchasing the halving could be a factor in the strong price performance of Bitcoin so far in 2020. The halving right now, based on our internal prediction models, is going to be between the 9th and the 12th of May. A key macro event happening around these dates is the Democratic primaries in New York and Connecticut, both big states in the US. And potentially a strong performance by a particular candidate could also contribute to macro headwinds and FOMO purchasing happening around the halving in early to mid-May. So it's something to keep an eye out for. And a few weeks out, coinciding with the Democratic primaries, we could see some halving FOMO purchasing activity.
Hello everyone, and thank you for joining me today. My name is Andrew Gillick and I lead research at BNC. Today I'm going to be talking about the market dependencies between gold and Bitcoin and their exposure to the legacy markets and coronavirus. So in the first chart, we're looking at the volumes of Bitcoin traded across the 4 major stablecoins. That's Pax USD, True USD, USDC, and US dollar Tether, USDT. In the aquamarine green, we can see that US dollar Tether still dominates by far, around 75% of traded volumes. It has been on a dominant trend for the past 6 years or so. And we use US dollar Tether as a proxy for the flows of Chinese and offshore trading in Bitcoin in particular, as Tether is quite accessible. It is renowned for having low AML, KYC barriers to entry. So in terms of the coronavirus narrative, that people from China and Asia have fled to Bitcoin as a store of value and a safe haven. Using this rough proxy, we haven't seen a giant jump in traded Tether volumes. And if anything, we've actually seen a bit of an increase in the volumes of True USD, a competitor, a more auditable and verifiable competitor to Tether. As I say, this is just a rough proxy for foreign offshore demand for US dollar Tether and Bitcoin, and is to be taken so. Zooming out now to the traded volumes of Bitcoin on the BLX, the Brave New Coin liquid indices, on a weekly time frame, going back to 2016. We can see that since late 2018, there's been what we call a bearish divergence between the price and volume, with price rising and volumes falling. This has been typically heralded as an omen. Looking at volumes here, we're just looking at the exchange traded volumes of Bitcoin, not the OTC markets or any derivative markets. And we're looking at the qualified exchanges that Brave New Coin uses for its indices, and that cleanses out any price manipulation and wash trading that might be going on. So an interesting trend that over the qualified exchanges, the top most liquid exchanges in Bitcoin trading, there has been a significant drop off in volumes over the past year and more. Now, if we zoom out again from the crypto markets to the legacy foreign exchange markets, we're looking here at data from the Bank of International Settlements triennial survey, which is the most comprehensive view of the FX trading landscape across the world. In the chart to the right, we can see that FX flows, FX turnover has been steadily increasing since 2000 and today stands at about $6.5 trillion average turnover per day. This is driven mainly by growth in derivative markets rather than the spot market, and the main drivers in derivatives have been FX swaps and forwards. The chart in the middle shows the hubs through which the world's FX flows go through, with London in the purple bars at the bottom dominating around 40% of FX flows. Tokyo is next, New York and Singapore are the next largest. What this chart shows is that although there's increasing volumes of FX flows, it's actually going through more centralized hubs and fewer of them, which also brings into play some potential risks as well. And also, like any system, decreases system resilience if there is knock-on effects from any crisis or if something goes wrong. The chart on the right shows the amount of flows coming from financial institutions to non-financial institutions, with the red line and the blue line being financial flows and the yellow line being non-financial flows, which indicates that the majority, 95% of FX flows, are actually dominated for financial purposes and profiteering rather than any economic productive activity. So from the same Bank of International Settlements data, we're now looking at the flows of the Chinese renminbi or yuan currency. And what this shows is that the renminbi is actually bucked the trend over the past decade. For most other emerging market currencies, the flows of most other emerging market currencies has actually been increasing steadily over the past few years, while the Chinese renminbi offshore flows have actually been flatlining. This also bucks the trend in China's growing share of global GDP, which has risen steadily over the past decade, and it attests to China's ability to control its capital flows, its offshore capital flows, through capital measures and restrictions, which will come into perhaps more focus when China does manage to launch a digital currency, which it has been in the process of and is about to do in the next year. Chinese renminbi, or digital Chinese renminbi, would give the country and the central bank the ability to have more capital controls over the flows, the foreign flows and domestic flows of the currency, and also perhaps give it very accurate and real-time, almost real-time data. Now, the next chart, we are looking at the price of gold in Chinese yuan and in US dollars. I'm using this as a proxy, a simplistic proxy for a flight to safe haven from both countries and both currencies, and inferring from the outperformance of gold in Chinese yuan in the yellow line, we can infer that it has been driven by a greater demand for gold in Chinese yuan than in US dollar. As I said, this is in nominal terms and just a rough proxy for a flight to safe haven, or a demand for gold as a safe haven in both countries. So arguably there has been more demand from China for gold due to the coronavirus. This chart goes back to mid-January, which is when the coronavirus breakout was reported. So what would be the effects on the gold and perhaps even the Bitcoin price from a sustained impact on Chinese and world GDP from the coronavirus? Well, here we're looking at the implied future returns of gold over the next 5 years, under the circumstance of Chinese GDP slowing to 5% from currently around a reported 6.5%. And Standard & Poor has estimated that the impact to Chinese GDP will be about 1.45% this year. And so what would the implied returns be? Well, we can see if there was a flight to gold as a safe haven, the return on gold this year would be 15.4%, and 2021 would be 7%, and so on, with a compound annual growth rate of around 8%. So the knock-on effects from the coronavirus would knock Chinese GDP down to 5%. This would also have knock-on effects to US GDP, which would bottom out at about 1.4% this year, and in aggregate, world GDP would drop to about 2.3% in 2020, which is not quite GFC levels, but a significant impact nonetheless. So what we can infer from the implied gold returns under this coronavirus knock-on effect scenario is that being a store of value asset, or at least having the narrative of a store of value asset and being quite reflexive in price, Bitcoin could perhaps have a similar bump up in price. And being a more reflexive asset even than gold, due to its virality on social media and in popular culture, it could have a far greater outperformance in a real risk-off situation and a return to store value and safe havens. This will be the theme of an upcoming BNC Research report, which looks at the resilience of gold and Bitcoin and quantifies the resilience of gold and Bitcoin as safe haven assets, and also looks at Bitcoin as a social phenomenon in terms of virality and narrative contagion. So, thank you very much for joining us for this presentation. I hope you all enjoyed it.
Okay, so there you are. A quick summary of where the markets are at the moment, where they're potentially headed during 2020. Please subscribe to the BNC channel and you'll be informed when we release our next quarterly review. Thanks for watching.